All right, so let's do it. Let's see how a financial planner makes a budget. I have to say, in my financial planning practice, I know there's client forward, client facing attire, and you're used to seeing suits and other things like that. But when I do the actual work, I prefer to be pretty comfortable because it partially reminds me of how I used to do my own budgeting for my own household. This is just a sample client in a software tool that I use. So I'm going to go ahead and click on this piggy bank icon. Honestly, most software like this is just built on a bunch of Excel spreadsheets and formulas. They're not too difficult to discern after you've been educated in financial planning, but certainly in budgeting, you don't need many tools. Pen and paper is fine. I think there are limitations to that in today's increasingly complex households where you have tons and tons of credit cards and debit cards. So the simpler your system can be, the easier it is and the easier the levels can approach it. But budgeting, there there's a misconception, I think, budgeting as a noun and budgeting as a verb. So my budget is a document, digital or piece of paper that says I make this much, I spend this much. Budgeting is the act of creating that document. But I think it goes a little bit further than that because who cares what your budget is? It's really the changes in your budget and the way you can manipulate it, dial up or dial down certain things that matters. And that's what I hope to get to here. But we got to start somewhere. So this is a chart up here that basically adds up or finds the sum of the various items down below. So income, I'm expanding it, and I'll probably add some more, and it will sum the total here. I actually want to change this here. Let's go. Great. So current budget, alternative one is what I want. There we go. Okay. So let's get started. I mean, first you need a pay stub. So in this case, I have a pay stub, but it's as a spreadsheet. I wanted to demonstrate this data pretty importantly because it kind of outlines some important things. There's your federal income tax. Now, that's honestly just an estimate, right? It's not actually how much you will owe, it's how much you're withholding to plan for what you will owe. I don't really like the way that's set up, but I understand the reasonings to some extent why. So, this is what you'll pay the IRS here from your pay stub. You'll never see it initially until, tax time. Social Security is actually broken down into two parts. So it's about 15%. There's an exact number you can look up, and it's up to a certain income level. If you earn more, you can pay up your Social Security portion and be done and have a heftier paycheck by $131, in this case, towards the end of the year. So once you've paid your part, you're done. It is split roughly 7% plus by the employee and 7% plus. Sorry, where's they combine it here, but essentially, 162.18 is the total of the two employee portions of Social Security and Medicare. So the employer pays 162, the employee pays 162 until a certain income level is reached, and it varies each year, so we can Google it. I just want this to be more timeless. And these are the amounts that go into the Social Security system. They're also called FICA. That's another way you can see them. Medicare doesn't have the salary cap. So the 7% ish that goes for Social Security by the employer pay and the employee pay, unless you're self employed, you pay both. It'll eventually stop once your salary reaches that cap. But Medicare, which is about, the 1% range, will continue against your salary. So you'll always be paying Medicare from each paycheck. Social Security, you may be topping out on. But for most Americans, you probably see them on every single paycheck, just based on the median salaries. And then another estimate for your California state income tax. When you filled out that form at the beginning of your employment that said, I have this many children, I'm married, my spouse has a job too, it's equal amount, and you would put, maybe they call it allowances, withholdings, maybe I withhold a little more, who knows? It's called a W-4 Form W-4 provided by the IRS, and it's the form that employers use to determine how much federal income tax and state income tax might be withheld. Some states don't even have a state income tax. So be aware of that. Additionally, California has short-term disability to pay into as well. For our purposes, these are important for the exercise, but today I really want to focus on how to just start sketching things out. It's important to start with what's known. Another thing on your pay stub is your payroll period. Sometimes people are paid every 2 weeks, and sometimes people are paid twice per month. Twice per month is on the 15th and 30th or 31st, respectively. Middle of the month, end of the month, you get a paycheck. That's 2 per month, 12 months in a year, 12 times 2, 24 payroll periods. Alternatively, if you're paid every other week, perhaps on Friday, that is every 2 weeks, which is more than twice per month. And it actually works out to, generally speaking, 26 payroll periods every 2 weeks. In this case, this is nuanced, but this person is paid 52 payroll periods every single week. Super rare. In my planning practice, I don't generally see that, but it is what it is. It's important to know how to read it. What's a payroll period? How often am I getting paid? And what does that mean in terms of a year? I like to look at budgeting in terms of a whole year divided by 12. If we narrowly focus in on what I pay each month, we're going to forget things like the auto insurance that I pay every 6 months, or property tax. If I'm a property owner, I pay that once, maybe twice per year. So we really want to, go beyond that. Okay. I also see that everything's pretty consistent here, which makes things a lot easier. So, equals this times 52, probably confirmed with the client. Are you paid 52 weeks of the year, vacation, et cetera, et cetera? And that's how I can get some determination. And I'm going to divide it by 12. In this case, for income, I always round down because I want my estimates to work in the favor of better off for the client, not worse. Whereas expenses, I may round up. The rounding 0.5 and up is usually round up, 0.4 and below is round down. I'm not always consistent. I do my best to be consistent, but in this case, I want to take, this amount and make it 9186. Probably could round it up to 7. I don't really want to. I want expenses to be rounded up and income to be rounded down, generally speaking. Sometimes I'm in a hurry. So that's the reality of being a working mom. Just had a kid come in. So great. We have client A income. I'm limited in characters in this. Again, this could be spreadsheets. You don't have to be super, so I took the weekly pay, net pay, multiplied it by 52 weeks and divided it by 12. Great. Right. Okay. So I happen to know this. There's also some other things that I know about this household. They're both self-employed. So even though client A receives a payroll check, there are also some business distributions. I also know that client B has bonuses. Great. I don't know what those are right now. So when I'm planning for a client, I do leave placeholders. Every bit of information that I have, I'd rather put a note in and sorted out over the process. And again, I'm not going to guess if I don't know, unless it's something extremely arbitrarily low that won't really impact results. I want them to get results. I also just realized this. I put in the net pay here, but I think for this exercise, oh no, I didn't. I put gross earnings. So gross earnings is before anything comes out of the paycheck. Net earnings, here, net pay, is gross earnings and then subtracting the employee taxes. So the employee tax lineup right here, 1,261 subtracted from 2,120. It looks a little high. Is that right? No, this is the total, employee tax total. So 2120 subtracting the sum of the employee taxes, which we can verify. So this is 630.52, 630.52. And then we get the net pay. It's really important to start to know how each of the items on your payroll or pay stub, which is the copy of the data of your payroll check, how all of these are determined. I'm a financial planner. I do this for clients all the time, and I run into issues. I run into issues on calculating payroll periods because sometimes the dates aren't very clear enough for me to know, and I have to look at a calendar and look back. Sometimes there's strange total columns, right? But you should know there's a total number you're paid. There are various lines of taxes that come out of your paycheck that you pay. Above and beyond that, the employer also pays some taxes on your behalf. There can be other deductions for health insurance. There can be other deductions for employee benefits. So be mindful of figuring it out. If you if you're not reaching your financial goals or you don't feel settled and affirmed that you know everything going on in your financial household, the pay stub is the best place to start, even before you're taking a look at your budget. In this case, being advanced at this, I'd say I'm putting the data in as I'm looking at the data, but spend some time with your pay stub. Break out all the amounts into an Excel spreadsheet if that's helpful. Start adding up columns to see what's what. Usually they will say employee deductions, pre-tax employee deductions, after-tax employer, et cetera, et cetera. And if you need help, reach out, particularly to your payroll providers. I mean, they should be able to offer you this information for free. It is what they're paid to do. So I really recommend it. It seems so simple. I've been my first paycheck I got when I was 15 years old working at REI. It's an outdoor sporting good company and a co-op actually. But I'm always stunned, even today, how a payroll pay stub can flummox me from a client and how much work it takes to understand it and learn it. But if you're getting, 24, 26, or 52 of these, certainly, we can take some of our mindless scroll time and learn a bit more about how we're paid. So, minor rant. So what's known? We got the gross earnings taken care of and handled. They do give me a gross tax figure, but I think I want to start looking at what these smaller tax items are. Also, I'm already noticing it here. I know the FICA limits are well above 110,000 a year, so I'm not going to worry too much. When I was studying, it was like 114,000 a year. I think it's like maybe 130, 40,000 a year. We can Google this. It's not hard to Google to find this out. So I'm pretty much assured that these Social Security and Medicare components will stay consistent. So let's do the same thing here. We're going to take gross and oh boy. Now remember, this is times 52. Otherwise, if you get paid twice per month, you do times 24. If you get paid every 2 weeks, times 26. But in all cases, to get the monthly, once you have your totals, divided by 12. Great. And then the last ones here. And I can also make sure I pull those formulas down. Not in this case. Just double checking. Great. So these are the monthly totals. Wah wah. I already know something about my budgeting tool here. I think they need a couple more line items, but we'll start. So let's look at client A, FICA. That's the Social Security amount. So again, sometimes when I do this, I like to make sure that I'm keeping track. And it, Social Security is FICA. Put it there. And then Medicare. I'm going to highlight that I've put it in. Great. It's going to do the automatic rounding for me, so it is what it is. And then I'm going to put the California SDI in other. And I'm going to put, I would say if you're building this on your own, just don't even get creative. Just use what you see. Because I can't edit these, which I wish I could. I would otherwise make them exactly as they show up on payroll in here. So that we're not rewriting things. I think that's pretty important. Also, since this is client A who's below client B, I'm putting it a little bit lower. Great. So we're kind of working through here, you know? Now we have to determine what we want to do for federal and state income taxes. These we can put in the data. It doesn't stop here though. We'll put state income tax. Oh yeah, we already put that in. Because the other spouse is going to have their components of income taxes as well. But I'll say this client in particular, this household, they have a lot of problems with their self-employed natures of how to stay on top of their estimated tax payments because one spouse is not paid payroll. They're paid just distributions from a business. So this exercise is extremely helpful. Also, why the focus on gross or the big number of income? I could just take the net amounts in this case because this is a self-employed household. But I have to admit, it's really important that we all know how much we're paying in taxes and what percentage that is. It's really, really important. If you haven't done that exercise, right? So let's say this person did not get any tax returns. 30% of their paycheck is going to taxes. Do you feel, I think this is a good way of checks and balances in the system. I mean, you vote, you determine where the money gets spent theoretically. So how do we keep track of that in terms of our lives? We're all busy people just trying to do the best we can. None of us are here, at least in my philosophy. I'm not trying to skirt around not paying the taxes I'm legally owed to pay. But I think it's really important. So additionally, we can get this figure here. Now again, 6.2%, right? And then Medicare, 1.45. The employer also pays 6.2% and 1.45%. And this might need to be cleaned up so you can see that in earnest. So when the employer taxes, they're paying the employer half or another 6.2 for your Social Security and another 1.45 for your Medicare. Great. So in my opinion, if I was given this pay stub or this report, earnings report, I would say that this spouse's income is effectively done and covered. Um, this employee is also the employer. So to some extent, the employer taxes is an important figure. But at this juncture, I don't think I need to worry too much about it. Great. Now, if they had other deductions, I could put those here. I know this as personal insurance expenses, but I like having a specific line item for households for all of their non-tax payroll deductions that they are having reducing their salaries. And the reason why is because those expenses likely, if we're looking at a retirement budget, aren't continuing. In retirement, you typically aren't saving, right? You should have already saved so that we could be spending the money that we have generating our new income sources, whether through investments, social security, rental income, etc. Pensions, maybe very small chances of that for too many. So when I see payroll deductions, that goes here. When I see retirement account contributions, it goes here. And I like to be very specific. So only one spouse in this case, client B is contributing. And the payroll will have it. So you can copy and paste the actual payroll title to it. And I don't have a figure for it. I just have it known, max out, divided by 12. So 23,000 if you're under the age of 50, so 49 years old or younger within the tax year. And you made at least 23,000 of net earnings, then you can contribute the max into your 401k, which is 23,000. On a monthly basis, that becomes 1,900. I'm going to put 17 because I want a negative impact on adding those extra dollars spend. It makes up for other, components of spend that are a little less, they're a little more loosey-goosey. Great. I'll be continuing to do more and more analysis on this because I know this household has self-employed health insurance, dental insurance. So that'll be important to put in here. Great. So what do we have now? We have a household that incomplete data, but we know they make roughly 20,000 a month. There are some income line items missing. We're going to go deeper into their spend data to figure out what those are, if we can. We have all their payroll deductions in place, aside from some of these other components of self-employment. And we have one spouse's entire tax withholdings. So now we need to get their personal expenses and we need to get their insurance expenses and the other spouse's tax information. Now, likely that's going to come from their actual tax return. So, pay stubs, some known data, knowing that the one spouse makes 10,000 a month, and a tax return. That's the minimum you need. We can put in some figures to make some estimates, right? If one spouse is paying 30,000 of net to taxes, let's assume the other spouse is too, and just blanketly state. I'm just going to put it in here as a placeholder, so it's not client B's FICA. So 30% of 10,000 is 3,000. Great. And we know that, let's just put a blanket figure for insurances because I've seen the spend data, and self-employed spending can be high. I'm just going to put 1,500 here. And bonuses, I'm going to put 2,000, and distributions is another 3,000. Interesting enough, if you do things like this or anything that ends in a 73, then we can know that that's an estimate. It's not exact or perfect, but I'm doing the best I can here. Great. So what does this tell me, right? We've kind of put some estimates in place. We said there's going to be some bonuses. We'll confirm and shore up what those are. There's some insurance stuff that we'll make sure we confirm those, and taxes will confirm. So this household brings in $24,000 a month. They have less than $10,000 a month left to spend on themselves. That's why it's not enough to just see your net paycheck amount. It's important to notice that difference, right? Oh, excuse me, I got it flipped. They have 9,000 going out the door. This is their net pay. So they bring in 24,000 and nearly 9 or 10,000 less is what they have left over. These are really important metrics to understand, extremely important to understand. And I might have even gotten the tax figure off because self-employed has to pay some self-employment taxes. So I'm going to add a little bit more there. So where do we go from here? We obviously have to confirm our estimates that we made in some of these categories. Okay, but I think I was shooting for the moon a little bit high. I'm okay with that. I essentially want to be able to say, oh, this number is actually a little bit higher. Great, right? But if I know there is no saving going on, $0 being saved, right? All we know is that there's a 401k amount, but it is saving, but it is also not intentionally saving, like taking money out of the checking account from your net pay and put it into a savings account. So let's assume there's no saving. I can confidently say, and there's no credit card debt accruing. So they pay the credit card debts in full every month and they're not explicitly saving. I can affirmatively tell them on average, every month for the year, you are spending $14,537. As I, refine those placeholders, it'll be more specific, but that alone should give you some real good pause about your spending. What does it mean to have 10,000 a month going to insurance, 401k, and taxes? What does that mean? How does that feel, right? I think it's important to say that we are not our gross salaries. We're not even our spending data. And I wish I would have started this video on this topic, but it's important to just be completely judgment free about your data. Maybe have a notebook next to you, or I don't know, a whiteboard, or who knows what other strategy. But as you're looking at this data and you have judgments rise, write down the judgment, but kind of say, okay, that judgment can live on that piece of paper and move away from me right now, because right now I'm just processing data. When I have clients, it's so easy for me I'm a third party. I don't care what they spend on. Frankly, I don't care if they overspend, but if their goals are to be different, this is a great way of understanding. But in terms of the data analysis and processing, anything you can do psychologically to separate the two is good. I think that's why spouses working together, if there are money issues in the relationship, having each spouse own a certain component, maybe, because these can be very emotional conversations. But at the end of the day, it's just like these number systems that came from thousands of years ago that we use to demonstrate what data is. And we just willy-nilly, like lemmings and ants, make our spending choices. And if we've never put an intentional lens on it, of course, we're going to have judgments. And that's okay. But find a way, if you can, to increasingly put more and more distance. So like identify what it is you're feeling. You're like, I'm feeling something wonky, or I'm feeling upset or regret, or who knows what else. Whether you can or cannot identify it, that you are identifying something, and put it to the side momentarily. And later we'll draw back on those, but more with curiosity. So how do we get at this figure? If this was a couple in my practice, typically speaking, I'm trying to tell clients, acting as if. And the best way to do that is to automate a specific savings number that goes into savings every month. So I could definitively put that amount in, right? I could have a savings line item. I don't really see it here, but I can have a savings line item that goes in here. It'll reduce this amount, but at least I know it's what's being saved. So I definitely want to get this number to zero. It's called $0 budgeting, or allocating your whole paycheck. et cetera, et cetera. Some households come to me and they don't know how much they're saving, but they're like, oh, after a few months, checking account accrues some dollars and I'll move it to savings. This is a way to discern what that might actually be, especially if they take money back from savings out. That's really hard. If you put 10,000 in or 12, let's say we put 15,000 into savings over the year, right? A little over 1,000 a month, but we took 3,000 back to pay for a vacation we took. That's net 12,000 into savings, so 1,000 a month. And it's really hard to discern when we're just looking at statements, right? Things get extremely complicated in that regard. So now we do the work of understanding what their personal and family expenses are. So I'm going to open that up. Okay, if you've watched this far, I just put earbuds in. See if it changes the quality here. So what do we have? Um, we have 2024 spend for this couple. Now, their spend tracking includes income. I may or may not include it. I think that your spend data is only as good as the data inputs, and we already have better data inputs. Now, this could be the place that I come to check out this figure, which was that business distributions figure from client A. And that would be it. So they have been tracking all of their expenses. And it just so happens that when you track through July 31st, you have 7 months of data. So if you take the total column and divide it by 7 months. Now, there's an additional component here when you're doing expense tracking called type. And we identify fixed versus variable. Fixed expense is going to be like a mortgage or a rent payment. It's the same every month, no matter what. I'm going to say fixed, right? Lowercase f, not quite this uppercase f. And the reason why is because all the work you could do on your variable expenses, meaning they change month to month, right? You can't necessarily eliminate a fixed expense, but you could move to a lower cost of living housing expense. Now, I know that's like, oh my gosh, how dare she suggest that? The reason why I say that is because there's only so much work one can do to lower your expenses. You make 100 grand, you spend 100 grand, hopefully, maybe not more. You can lower that to 90 grand, right? And you have 10,000 a year. And you can continue to whittle away. And, increasingly though, after the big wins to get that first 10K of spend reduced and directed into savings or debt payments, you kind of end up in this spot where it's like you can only save so much before the quality of your life starts to go down with your spending decreases. And that's where that statistic comes up, like household income of 70 grand per year makes a difference. Under that, you really are on some poverty threshold for household income. I'm not talking like a single individual who can live with roommates. I'm talking to households of maybe 2 to 4 people. At the 70K gross big number per year of income, things start to change. You actually have some more flexibility in what you can spend and cut and things like that. Under that amount, it's increasingly difficult. And is it an exact 70,000 or is it 73 and 554 a year? You can look up the data on Google or any search engine or use ChatGPT or any AI tool. They can probably better distinguish that. The level of happiness doesn't tend to go up with more spend after 70,000, however. So we have to keep spending in mind that it is important, but it's not the only part of the equation. There's also earning more, and we can talk about all of those items, but let me know in the comments if you want to look at any of the particular items we talked about in more depth. Also, let me know on the sounds, adding the earbuds. So my next step then is to take all of these expenses as reported and put them into, the custom categories for personal and family expenses. Now, this is just their personal spend. There's some business spend that integrates some of their personal life items. I'm going to want to take a look at that too, right? But let's take a step back. Like, who cares about all this? Like, what am I actually trying to get at, right? I could just take a total figure too. In a pinch, I can do that. So let's add this all up, and I can just put in 12,497. I'm just going to put it here, 12,497. Awesome. They're doing great. There's a 2,000 extra a month. You guys are good. No, if they're not intentionally saving this, they're likely spending this, and probably it could be going to taxes, but we, made some estimates elsewhere. It could be being burned through personal expenses through business spend. So lots of other things to take a look at here. So having said that, and it's only 7 months of data for the year, we're missing key elements like property taxes and earnest. So what I want to do with this figure is start to put in the actual amounts. So, and they have a first mortgage and second mortgage. Again, you and I may have judgments about that. It's important not to bring our judgments into somebody else's spend. If they are accomplishing their goals, then there's no problem. If they aren't, then we can further take a look at that. In today's interest rate environment in 2024, their mortgages are the lowest that they could anticipate paying for them. So there is that reality that they are fixed costs right now. They're fixed expenses, and it would take a huge amount of effort, legwork, and changes to impact those numbers. They also include, I already know, taxes and insurance for the most part. um, and that's another element where it gets tricky. When you have impounded taxes and insurance, what might we do to kind of unravel those expenses? Again, if the client had no problem and we weren't looking for extra places to save, or they had no problem paying their estimated tax payments every quarter, I would say, well, this is above and beyond to do all this work. But in this case, I think they really need to know, right? So this is where we would start putting these exact amounts. So I'd have to research their mortgage with them, put the exact amount of mortgage in there. I'd have to research the second mortgage, put that exact amount in there. And we'd have to get their actual annual real estate tax in here. They have 2 lots on their property, so they pay 2 property tax payments that I know. They don't have a home equity line of credit. There are homeowners insurance, but they're in California. And I don't know if you know much about certain areas of California, but homeowners insurance has become a very strange, difficult landscape, as well as increasing costs. So they've had at least one cancellation, they've had non-renewals, and as dramatic as that can sound, again, kind of approach it with no judgment. We're just looking for the data. My recommendations can come much later after I've had a chance to synthesize all this. This might not be an area that we focus on. There are no homeowners association fees or HOA fees because they do not live in a condo. Now, this is an interesting question. Do I put their housing costs for these items like electricity, gas, trash, water in at the home level? I probably will, because I know the end goal is to get some semblance of what a retirement budget might look like in today's dollars. So if they were to retire, what do they need to be spending on? I might do that, because even if their mortgages end, they will have housing expenses in here, and I want those to be reflected. So I probably will. Sometimes I put them up here in the personal and family expense, and I haven't broken them out separately in the home area. In this case, I'm going to. I don't like to because I can't customize these. So that's why I don't like to. Vehicle, debatable whether I want to add in there or not. In this case, I may, because I know they need a car, essentially. So this is a, first stab. So my work now, I'm going to be taking this spreadsheet, and they track these because that's how they want to track them. I'm going to be more specific on their fixed expenses since they are known. I'm going to have to use other resources to get there because they switched who paid what in the year. So this isn't really exactly reflective. So I'm going to get the actual annual totals, divide them by 12 and put them in for things like their umbrella coverage, their mortgages. Income tax is going to come from the tax return. You can just do that. Property tax is going to come from property tax. Life insurance is fixed because they took my advice about that. Great. I mean, I probably missed something. So if I did, I'll go back. But these are the ones that require further investigation. Otherwise, I can go ahead and take these amounts in. So, you know, that's how we get to affirm this figure. There's some other places I have to look to confirm or affirm some of the other figures. But this is not even really the budgeting part. This is just data assembly at this point, right? There's various things, and people can use tools to track their expenses, like Monarch, Copilot.money, I think Rocket Money, maybe Rocket Finance, one of those tools. If you know any more, link them in the comments for people. Mint.com was a big player, but they have since gone away. This client in particular uses a free bookkeeping tool, and I don't think that bookkeeping tool offers that free level anymore. Some people can take their statements and, copy and paste or assemble them separately. I think it just varies on your household structure. And I'll do a video on this if it's something that people want to see. When I was in my 20s, I tried in earnest to write down my expenses. I had no success writing them down with pencil and pen ever. So I started a spreadsheet method, and that worked extremely well to get me results. But just because I tracked doesn't mean I was successful for several months. So I would say if you're starting to track your expenses, don't expect being able to make meaningful changes until you have 6 to 12 months worth of data. Now, that does not mean don't make changes and don't try to impact your budget to reach your goals. And again, a bigger conversation about goals is necessary there too. But target your efforts where and if you can.